Dear viewers, welcome to yet another edition of Expert Speaks. We recently completed Q4 of FY 22-23, and it's time that we take stock of what happened in the last quarter of financial year 22-23. In this episode, our ACE fund manager, Ms. Harini Dedhia, is going to explain to you what is that she is seeing in the stock market, which are the winners, which are the losers, what are the macro changes that are happening in the economy, and all the points that you need to know to be a successful investor. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to take you through the market outlook of Q1 of 23-24, as well as to check what went right and what went wrong, who won, who lost, what are the macroeconomic changes that are happening in the economy, I have invited to the program my ACE faculty and one of the most prominent fund managers who is evolving in India today, Ms. Harini Dedhia. Harini Dedhia is a very, very popular speaker on my channel. If any of you are the ones who are watching my channel for the first time, let me give you a brief introduction of Ms. Harini Dedhia. She started her career from New York many years before. She was working for a hedge fund. She started her career in India a few years before with Ghalla Bansali Stock Exchange. She was managing Truffle Investment. Later, she is currently now working with Tamohara Boutique PMS in Mumbai, and the funds that she has been managing, the PMS accounts, have won 4-star rating both by CRISIL and PMS Bazaar. Welcome to the show, Ms. Harini Dedhia.
Great to be on your show as always, Doctor, and thank you so much for inviting me again.
Harini, I have been very, very impressed with the way you go through this research and put forward what you saw in the past and what might happen in the future. And you have done this in the last quarterly episode as well. And we said that we'll make this as a quarterly episode. Today, can you take us through what happened in the last quarter and what do you see, which direction the markets are heading from the eyes of a fund manager? What are the things that you are looking at? I'll not be disturbing you. I'll not be asking you any question for the ease of flow of information. It's all over to you and the audience is eagerly waiting for you.
Great. Thank you so much. I'll go ahead and walk our audience through what we think has happened in terms of macros, how the macros stacked up in the last quarter, and also how have the earnings done, because equity markets really are a product of two things. They're a product of earnings and valuations. Earnings are dependent upon how the businesses are performing, the underlying companies are doing, and valuations take a lot of cues from the stability or the volatility that are occurring in the macros and the geopolitical scenarios, etc., in the world. So I think I'll give a brief overview of the macros first and then move on to earnings. When we look at how the macros have stacked up over the last quarter, I think it's safe to say that nothing much has happened in the equity markets, right? I think be it the last 1 quarter or 1 year even, markets have been pretty flat, be it in India or in the US. And broadly, most other markets that are well researched have not given any returns to investor in the last 18-20 months plus now. Though it seems flat on the surface, the index levels, it hides a lot of the churn, the emotion, the volatility that we've seen really happening in these underlying stock names that are possibly there in each individual's portfolios. What has happened at the same time in fixed income is very, very interesting. India has obviously also seen a rate hike cycle like the rest of the world. But perhaps the most significant rate hike cycle, I think, was witnessed in the US, which has seen the steepest rate hikes happening in the last 3 decades. So think about it. If you had a mortgage going on in the US, your mortgage was somehow benchmarked to a 0.5% repo rate, and today it's benchmarked to 5% repo rate. It is a significant change in cash flows that has affected a lot of consumers and a lot of homeowners in the US. This has happened because inflation in the last 1 year has really been at an elevated level. How do we know this? If you just see the March numbers for inflation, US inflation was closer to 8% when an emerging market like India saw inflation closer to 6%. Even today, US inflation is higher than what we are seeing in India, which is sort of unheard of. We never see this happening. If US was to be at 7, 8% inflation, you would have imagined India being at 10, 11, 12% inflation like we saw in the early 2011 to 12 period. But that is really not the case this time around. But the good news is that inflation in both these economies and mostly all around the world has cooled off. It's not cooled off significantly as yet, but it's definitely plateauing and edging downwards. The whole opening up and revenge spend that we saw, that has come down significantly. And a lot of businesses were all obviously worried that we don't know when lockdowns get imposed again. So if I had to import something from another country, let's just stock up everything, let's just pile up on inventory. So that had led to a lot of artificial demand that was created in the economies around the world. And that has come off significantly now, which is now showing its effect in prices, right? Because prices are simply a matter of demand and supply. It's very simple economics there. What has happened in our currency is, devastating to me when I go to travel outside, because I earn in rupees and I end up spending in whatever external currencies out there, but you typically convert to dollars first. So the rupee has fallen from 76 rupees to a dollar to almost 83, 82 rupees now. The two things that really affect currency on a broader level, at least from what I understand from my economics degree in college, is one is the current account deficit. How much are you importing versus what you're able to export to the other countries? Because what you import creates a demand for the other currency, and what you export creates a demand for your currency. So that is one very fundamental factor. And the second factor is, what is the differential in inflation rates, right? If one country is seeing inflation at 2% and another at 4%, it is logical that over a longer duration of time, that 2% depreciation should affect the second country in their currency. I think with that logic in mind, it is important to note that India's current account deficit had worsened actually. In September, we had gone as high as 4.4% of GDP, which is unusually high. But that has now cooled off to 2.2% in the December quarter. We are awaiting the March numbers, but what had accelerated from 1.5% had gone up to 4% and now cooled off to 2.2. So that's good news for the Indian currency coming in. And that we're already seeing in the RBI Forex reserves also. The amount they had to spend sort of trying to defend the rupee a little bit here and there, that seems to have leveled off now. And the other thing is, in the inflation arbitrage, so to speak, between the two countries, we're seeing India actually fare a little bit better than the West currently. So if I had to wager a guess, I would say, if not down, the rupee stays around at these levels. I don't really see too much hit on the currency coming any longer. Crude oil has also cooled off, which is a very good sign for India. Cooled off from $100 a barrel to about $76 a barrel now. And for all the aunties and the mothers and the grandmothers there, the great news is that gold is doing exceptionally well. So I was told by my mother as well, that you guys have given zero return in the last year, and see what my gold portfolio has done. But jokes aside, I think gold has been very resilient, and in fact has now crossed about $2,000 as well in the month of April. So the way the macros are stacking up is, between March and December last year, we saw a lot of pieces moving. Between December and March, we saw a lot of things cooling off, plateauing, stabilizing, perhaps at a new elevated level, but still businesses love predictability. They like stability. So you tell them that this is the new level and this is what you have to work with. That is what businesses like. That is what we like as investors. So that is, at least one sort of silver lining, so to speak, for the equity markets to take off from the macro scenario that is shaped up. At the bottom, I have, noted our proprietary scoring system, and the way we look at businesses and the quality of the earnings of those businesses for the BSE 200 companies. So these are the top 200 companies listed in India. On an average, there has been a deterioration of score. We are awaiting March quarter numbers now from companies. So the IT companies have started reporting their numbers. Obviously, there's an odd company like HDFC Bank that's already reported, but we'll see a lot of these companies report numbers over the next 1 month. And if I had to wager a guess, I would say that March 23 score is closer to December 22, if not slightly under. I don't think the quality of earnings has been great. The simple reason for this is when interest rates go through the hike that they've gone through, a lot of capital allocation in businesses has to be rethunk. A lot of working capital requirements for businesses really take a hit in terms of planning. And even though your operating profits, so to speak, on your P&L grow, it takes time for your cash flows to stabilize because you have a lot of rethinking to do in terms of financing your company's ongoing operations. So this is how the macros have stacked up. Now let's go deeper into the earnings and try to understand what has actually happened, in the underlying of the index, which is the companies and how the businesses fared. I think the 9-month performance, because we have a complete data set for 9 months now, the 9-month performance of FY23 has seen a 11% operating profit growth. And I think this is sort of the number to work with more than anything else, simply because there's a lot of, like I said, a lot of capital allocation decision that can change the PAT growth numbers currently. So let's just focus on operating profit growth because it tells us about the operating strength of the companies currently. This growth has been predominantly driven by the outperformance by the Indian banking sector. Indian banking sector, let me tell you, has probably posted one of its best years ever, right? So all the pain that we've gone through, all the headlines that we've endured in terms of NPA and NCLT and all of that, that is all, resulted in this stellar performance by the banking sector. So when I look at how on a broader level the index earnings have performed, we are going to see mostly a 10% growth. I mean, it might be 9.5, it might be 10.5, depending on how numbers come out in the next 1 month, but it's more or less going to be in the 10% growth number. We're not expecting outlandish growth coming up in the next 2 years. I think 14-15% compounding in earnings is what we're expecting in the next 2 years. Now, just a caveat, this is my fallacy as an analyst to believe that it will actually come 14% 1 year, 14% the next year. If you see how the EPS growth behaves, 1 year it's good, the next year it's bad, the next year it's very good. And that's how life is. But, on Excel sheet, when we try to understand numbers, we obviously just put a broader trend line to understand numbers on the index level. And for individual companies, obviously, we do a lot more work in figuring out what are the moving pieces and parts. But I think this is where earnings are at, 10% growth. If I had to wager a guess of how things will shape up going forward in terms of earnings alone, I think for the next 2 quarters still, we will see pain. So last quarterly call, I'd said next 9 months. So now I'm revising that to next 6 months. We're going to see a lot of disappointment in earnings. I think September quarter onwards, but definitely December quarter onwards in this calendar year, we will see a reversal to normal earnings again. So where margins got impacted badly last year, we are going to see those margins come back to normal because businesses will adjust to a new reality and figure out plans. Because if you're running 1,000 crore, 2,000 crore enterprise, you have a knack in you to be anti-fragile, so to speak, right? So you adjust to the new reality and you come back with a bang. So I think that these businesses have seen an earnings correction and they will come back to normal. If not by September quarter, definitely by December quarter onwards. Now, this is probably the most staggering chart for anybody who wants to invest in India today. Why is it a staggering chart for me? Is that the total number of FII outflow from this country. So we've seen a 132,000 crore of outflow this calendar year 22. When you compare it to a crisis of 2008, when the index fell by 50-60%, the number is almost 3.5x of that in terms of rupees. Yet the markets have shown zero reaction, at least on the headline number, which is the index number. So index is flat, but FIIs have pulled out more than 3 to 3.5 times of what they pulled out in the 2008 global financial crisis. What does that tell you? That even though we are an emerging market, because of the domestic equity culture that has shaped up in India, and because of how well the domestic funds have done in terms of investor awareness, I think there is a certain degree of resilience that has come into the markets, which is unseen in a lot of the other emerging markets. So I'm by no means saying that we will not have the volatility of emerging markets, but I'm definitely saying that we will do a shade better than the other emerging markets for this reason alone, because FII's outflow do not impact us as much anymore. So how would the small and mid caps now pan out? Because a lot of us, when we invest in countries, we have our investments in these companies as well. I think pre-election year, every single time, we've seen a significant negative performance by small and mid cap indices in India. And, about 6 months before election, something happens. People are renewed with enthusiasm for the new government. The government starts spending a lot on the ground to, garner votes and support. But whatever it is, there is a wave of positivity that comes into the equity markets. So if you take the recent most example, in 2019, around the election time, we started recovering. 6 months before that, we started recovering post the IL&FS and NBFC crisis. In 2014, 6 months before election, we started recovering from the Euro dead zone crisis. In 2009, we started recovering from the abyss of the great financial crisis. So somewhere 6 months before election, something happens. I don't know why it happens every single time. I certainly think it is correlation, not causation, but it happens every single time. And I think which is also something that supports our thesis that another 6 months or so, and you will see the Indian equity markets starting to do decently well again. And it is not just because of this correlation that we are sort of making that assertion. I will say that this assertion is based on a number of factors. So let's now summarize everything that we've seen on the macro side and on the earnings side. We've seen double-digit growth, yet markets do nothing for 20 months. So in effect, there has been a 20% or so of valuation correction that has come into the markets, right? Because markets are down 7 to 8% from their top. And over the last 18-20 months, we've seen about 12-13% of earnings growth, if not higher. So there's a 20% correction in the valuation of the market. Earnings, we believe, should start doing well September quarter onwards, or perhaps latest by December quarter onwards. Election year, there has been a significant correlation in how things shape up. At least in terms of earnings and in terms of stability and predictability, things will shape up very well 6 months from today. Now let's look at the individual sectors, what has worked and what has not worked in the Indian markets. I think both winners and losers, there are surprises on both sides. I think pharmaceuticals, healthcare, but predominantly pharma and capital goods. These are two sectors that have been written off for the last 6-7 years that have done exceedingly well in terms of earnings in the last possibly 9 months or possibly even 1 year now. And the darlings of the last 5-6 years of the fund managers and of the markets, which are chemical companies and consumer names, both consumer durables and FMCG, have done really bad, both in terms of volume degrowth that has happened in the last 9 months or so, but also in terms of margins really taking a hit. Banking and auto, I think they were expected to do well, so they did well. So we're not seeing too many surprises over there. But healthcare and capital goods on the positive side has surprised a lot of people, and chemicals and consumer has surprised a lot of people on the negative side. And I will spend now the second segment sort of delving a little bit deeper into, what I thought of these sectors as per our last quarterly conversation and what I think, if I think something differently happening today. So in the financial banking space, I think the Goldilocks period is coming to an end. I think Indian banks have never been stronger. And despite this, I would say that, we're looking to sort of trim our positions right now, because we personally believe that this combination that we got of growth in credit coming back to a normal, credit costs being at the lowest ever levels that it has been at, that will sort of normalize. You will see a margin compression, because if RBI has come and increased my repo rates. My cost of funds has effectively gone up today. I may or may not be able to pass on everything now to my customers because the competition has also gone up today. So would you believe HDFC Bank today in the last quarter has been opening 6 branches every day? I mean, to think of the scale is unreal. So there is definitely competition that is being stepped up by one of the largest players in the market. And we think that while earnings growth will definitely be there, we think that the Goldilocks period is sort of coming to an end, and we still hold that view. Within the pharma and healthcare space, I think last time also we said this, that domestic pharma has continued to do well. And I'll just spend a minute on US facing pharma companies or US facing portion of the business. I think pricing pressure has eased off because there's a lot of drug shortages in America today and even in some European markets. And I think one thing that everybody views as a negative, which is US FDA audits coming on, it's a two-way street, right? What is an auditor is actually good for a good guy and it's bad for the bad guy. For the good guy, it is an affirmation, attestation that you're doing something right. So US FDA audits are good for the good pharma companies because it, one, instills a lot of faith in their customers. And second, it also means that new approvals can be restarted from those locations, right? For the bad guys who are trying to cut corners, well, the auditors will come and catch you. But I think overall, US facing pharma, which has been a big pain point for these companies for the last 7 years, will start doing very well, has already started doing well. But I think market is still in the disbelief, right? Because 7 years of non-performance will not be reversed by 7 months of performance. You will need a little more time to believe that. And I think we're going into an election year now, so infra will do really well. We've covered all these points in the last quarterly call of tendering activity, picking up. We are seeing a lot of investment by foreign governments, including the government of Japan. Private capex has also picked up. So we believe that infra will continue to do really well. I mean, if any of you ever visit India, I would highly recommend try out the Vande Bharat trains. I mean, it puts airline industry to the shame. So definitely highly recommend that. And that's the kind of work that's been happening in India. And barring Bombay, I think everywhere else, roads have become fantastic in India. I think as people of Bombay, I think we will continue to always suffer over here. But rest of the country has done really, really well on this front. So the only other sector that I would want to cover in this particular quarterly call is in the auto industry. I think auto re-rating, so to speak, right, where valuations correct from a low to a normal level, that has happened. But I think we will see sustained growth coming in again in passenger vehicles and in commercial vehicles. I think one thing where we differ from probably the consensus today is we believe that two-wheelers will do really well or can really surprise versus what people are expecting it to be. So would you believe that in 2018, we sold about 2.2 crore two-wheelers in India? In last FY23, we sold 1.58 crores. Till date, the number of two-wheelers being sold in India is 25% lower than what was the scenario 5 years ago. And that is just something that we think is going to self-correct, right? If I was just thinking of myself as a customer of two-wheelers, I think the biggest change that happened was 2 years ago. There was a 30% increase that happened due to regulatory changes, due to insurance norm changes in a price of a motorcycle or an entry motorcycle in India, so to speak. And when there is such a steep increase in a consumer good, as a consumer, you and I will believe, oh, this is a one-time thing. Let me wait for some time. This is something we do with stocks as well. Stock goes up 30%. We're like, I really want to buy it, but I just hold off right now because it's increased too much. Let's just wait for a better price. And it's been 2 years where the prices of these two-wheelers have endured. And I think now the customer has sort of, one, seen a wage inflation in the same time. And second, accepted the reality that, look, hey, if I want to buy a bike or a motorcycle, this is just the price I'm going to have to pay. So I think two-wheelers, we are seeing a lot of the traditional OEMs will do really well because for all the new age tech companies that are, really setting up capacity and or importing from China and selling their electric vehicles in India, I think the distribution network, the trust and the engineering prowess that our traditional OEMs have will also be translated into their EV brand. So Hero has launched their EV brand. Bajaj has now launched their EV brand. So all of these guys sort of waited for an ecosystem to be created. And then now they're aggressively coming out with their EV variants as well. And I think the traditional variants will come back to a normal. So I would think that in autos, two-wheelers have a chance to give you disproportionate returns. Apart from that, we would see normal returns because I think margin recovery will be under play and volumes will sustain. So I think we'll see good returns from there. But I think this pretty much summarizes our macro and our equity market and our sectoral outlook, where we believe that over the next 6 months would be a great time to invest in India. I may be biased in saying that, I completely admit, but I think the data suggests the same, that there has been a stability and hence predictability for businesses in the macro, and earnings should do well from September, if not September, definitely December quarter onwards. And remember, markets are a forward discounting machine, typically. So if you think earnings are going to do well in December, your bets need to be in before December. That is my take on it. And I think with this, I would hand it over again to you, Dr. Bhatt, if you have any thoughts, questions, or remarks on the same.
Harini, thank you very much for that description of what happened in the last quarter, what you think as a fund manager. It's a difficult job. I know that is how technical it gets and how, number crunching and, looking into past, future, interest rate, inflation, so many numbers to play around with. And you have tried your best to make it as simple as possible so that the audience can absorb on that. We'll continue to strive to make it as simple, as interesting for the customer. I have one question for you. That's an unannounced quiz for you right now. My audience is asking one question to me. I want to invest in India. Should I invest it today or should I invest it next year? As a fund manager, what is the answer that you would like to give to these investors who are in the waiting line now?
I think it always pays to invest in uncertain and volatile times. So, you don't want to invest once the market has picked a direction. And I think my conclusion so far is that next year today, we'll be sitting at a very different kind of a market and mindset. So definitely, if there's a choice between today and 1 year from today, I would pick today.
Thank you very much. I'll be talking about the same thing in my next episode on Friday, where I talk about your life, your money. This is the thought which came to my mind. I should speak to my audience about when is it the right time for them to invest, today or the next year. And I just thought I'll check from you your views as well. Thank you very much for these inputs. Thank you very much for your time. I know how busy you are, how difficult to get an appointment with you, but nevertheless, you have been very kind enough to spare your time and give the simplified version of your research paper to us. Our gratitude goes to you for all this kindness. Thank you very much for appearing on the channel.
Thank you so much. As always, it's my honor and pleasure to be in conversation with you on your channel. Thank you so much, sir.
Dear viewers, hope the episode that we have done today gave you an understanding of what's happening in the economy and what you can expect going forward. As told by Harini, equity market is all about discounting of the future. You see markets correcting when the economy is doing very well, thinking that the economy will not do well going forward. The reverse is also true. If markets are not doing well at the moment, or the economy is not doing well at the moment, but the investors or the community thinks that things are going to change, markets will move well ahead of time. So you should consider investing in India. If you have an intention to invest in India, it's a right time to get started now than to wait for a future appropriate date. Thank you very much for watching this episode. If you have not yet subscribed for this channel, do consider hitting the subscribe button. And do not forget to share my videos with your near and dear ones and friends and relatives. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another expert with an interesting and practical subject next Tuesday. Till then, stay safe.
Press the bell icon for more details and subscribe our channel.